Hey everyone, welcome back to Corporate Decoder, the place where we uncover the hidden stories in corporate filings, and today we're diving into Solarius Capital Acquisition, Corp's quarterly report. And it looks like this company's getting ready for some big moves, maybe too big too soon. Let's jump right into the financials, because that's where the real action is. At the end of June 2025, Solarius Capital Acquisition Corp had very little cash, just about $8,000, which is practically nothing when you're talking about corporate operations. What's more interesting is the debt they've taken on even at this early stage. They have over $500,000 in liabilities, which is way more than their total assets. This is a classic sign of a company spending a lot of money to get off the ground, perhaps on offerings and other setup costs. Speaking of offering costs, they've racked up nearly $500,000 in deferred offering costs. These are expenses related to their initial public offering or IPO that they haven't fully expensed yet. It shows they've been busy getting ready to go public. Now, look at their shareholders' equity. They have a significant deficit, meaning their liabilities outweigh their assets. This is pretty common for a company that's just starting out, especially a SPAC like this one, which is essentially a company formed to acquire another business. They've issued a good number of Class B ordinary shares, over 5.7 million of them, to their sponsor, Solarius Capital Sponsor. This is typical for a SPAC, giving the sponsor a stake in exchange for getting the company off the ground. Their statement of operations for the period of April 1st to June 30th, 2025 shows a net loss of over $77,000. This is purely from formation and administrative expenses. They haven't generated any revenue yet, which is expected since they haven't completed their main business combination. When we look at cash flow, it's all negative for operations. They use nearly $3,500 in operating activities. This is because of those formation and admin costs, but also changes in how they manage their money. On the flip side, they brought in over $11,000 through financing activities. This was mainly from a loan related to their sponsor. It's crucial to understand that as of June 30th, their actual cash was almost zero. The $8,000 in cash equivalents is basically pocket change for a company this size. All their major funding is tied up in the IPO and private placements, which we'll discuss later. The company is following accounting rules that require them to keep track of all the costs associated with their IPO. These deferred costs are significant, showing the expense involved in bringing a company to the public market. It's a big upfront investment before any real business activity can begin. They also talk about fair value, which is basically what an asset or liability is worth on the open market. This is important for understanding all their financial instruments, but for now it mainly ties back to the fact that their current financial instruments are mostly short-term, so their book value is close to their real value. An interesting note here is about their tax situation. Being incorporated in the Cayman Islands means they are currently not subject to income taxes in either the Cayman Islands or the United States. This is a common strategy for companies to minimize tax burdens, especially in their early stages. They also have to look at derivative financial instruments, which are contracts whose value comes from something else, like stocks or bonds. They're examining these carefully to make sure they're accounting for them correctly, but it seems like the main derivative here is related to their warrants. When you look at the net loss per share, it's a bit of a negative number, which is expected given their situation. They're calculating this based on the shares they have out, and importantly, they're excluding shares that could be forfeited. This is a detail that shows the complexity of SPAC accounting. The company is also adopting new accounting standards to improve how they report information about their business segments. For Solarius, they only have one reportable segment since they're a shell company for acquisition. This means all the information they report is consolidated into a single view. Now let's talk about the big event, the initial public offering, or IPO, which happened on July 17th, 2025. They sold over 17 million units, with each unit including a share and half a warrant. The IPO price was $10 per unit, bringing in a massive $172.5 million. This is the main cash infusion for the company. It's interesting to note that as of June 30th, there were no public warrants outstanding yet, even though the IPO is happening soon after. These warrants give the holder the right to buy shares at a certain price, and they become a big part of the company's future financial picture. They've also entered into a warrant agreement which lays out the rules for these warrants. It's all very precise, detailing when they can be exercised when they expire and even how they might be redeemed by the company. A key point here is the redemption clause for warrants. The company can redeem these warrants if the share price hits $18 for a certain period. This is a way for them to clean up their capital structure, but it also means warrant holders need to be watchful of that target price. Right alongside the IPO, the sponsor also bought private placement units, about 500,000 of them, also at $10 each. This brought in another $4.5 million. These private units are similar to the public ones, but come with some extra perks for the sponsor, like registration rights and longer lockup periods. As the company is aiming to acquire another business, it only operates as a single segment. Its chief operating decision maker, who in this case is the chief financial officer, reviews the company's performance as a whole. They primarily look at the net income or loss and total assets to make strategic decisions. Going back to the sponsor, they got a deal on founder shares. On April 4th, they were issued over 5.7 million Class B shares for just $25,000. That's pennies per share. These founder shares carry voting rights before the business combination and have some transfer restrictions. They're also subject to forfeiture if the underwriter's option isn't fully used, but in Solarius's case, the underwriters did exercise their option fully, so none of those founder shares were forfeited. And let's not forget that loan from the sponsor. They provided a promissory note for up to $400,000 to cover IPO expenses. As of June 30th, they had borrowed over $147,000 from this note. It was non-interest bearing and was fully repaid on July 17th, right after the IPO. There's also an agreement for administrative services where they pay the sponsor $30,000 monthly for office and other support. Plus, they agree to indemnify the sponsor against any claims arising from their operations. This is standard practice to protect the sponsor, but also means ongoing costs. Now, for the risks. Geopolitical instability, like the wars in Ukraine and the Middle East, is a major concern. These conflicts can cause market disruptions, affect commodity prices, and create supply chain issues, all of which could impact Solarius's ability to find and complete a business combination or affect the target business's performance. Holders of founder shares, private placement units, and any working capital units get registration rights. This means Solarius has to register their securities so they can be resold. They can make up to 3 demands for registrations, and they also have piggyback rights to be included in other registrations. The underwriters are getting handsome fees for their role. They get a 2% underwriting discount on the gross proceeds and a hefty 4% deferred commission, which is paid out later. In this case, upon the business combination, they also got reimbursed for some expenses, showing the significant costs involved in an IPO. Looking at their equity structure, they have authorized preference shares, Class A ordinary shares, and Class B ordinary shares, and Class B ordinary shares. As of June 30th, there were no preference or Class A shares issued. The authorized Class A shares are a large number, though, over 400 million, indicating flexibility for future offerings or acquisitions. And on voting rights, both Class A and Class B shareholders will vote together, but before the business combination, only Class B holders have a say on appointing directors and moving the company to a different jurisdiction. This gives the sponsor significant control in the early stages. The big event after this reporting period on July 17, 2025 was the IPO closing, as we mentioned, bringing in $1720 and $1725 million, and the private placement to the sponsor for $455 million. A whopping $173.3 million from these proceeds were then put into a trust account. Now let's talk about management's perspective. They're really upfront about this being a blank check company formed to find a business to combine with. They expect to spend a lot on due diligence and legal fees for this business combination. Management believes they will have enough funds from the IPO to cover their expenses before finding a target business. However, they do mention they might need additional financing if their estimates are off or if they decide to acquire a very expensive company. The sponsor might provide more loans in that scenario. Regarding internal controls, management says their disclosure controls are effective. This means they have processes in place to ensure that all required information is accurately reported on time. They also note that for a period and won't be providing a full internal controls report yet. As for risks, the company points to their final prospectus for detailed information. Essentially, any of the risks mentioned there could really hurt their business or financial results. They haven't added any new major risks since that prospectus. Finally, looking at the exhibits, they've filed various agreements, including the Administrative Services Agreement and certifications from their CEO and CFO, which is pretty standard for these reports. Now, looking at these results more broadly, Solarius Capital Acquisition Corp is in a very early stage, as expected for a SPAC. They've successfully completed their IPO. and had secured significant capital. However, their current balance sheet shows a deficit with liabilities far exceeding assets. The reliance on sponsor loans and the management's ability to find a suitable business combination are the biggest factors to watch. The significant deferred offering costs highlight the expense of going public, and the sponsor's control through Class B shares and initial funding is a key aspect of their structure. The risks tied to geopolitical instability are also a genuine concern that could impact their efforts to find a target. The company's direction is entirely dependent on its ability to execute a successful business combination. The strengths are the capital raised and the sponsor's experience in financial services. The weaknesses are the current lack of operations, the financial deficit, and the timeline pressure to find a target before their funds are depleted or they are forced to liquidate. An opportunity lies in identifying an undervalued target in their core sectors like asset management or wealth management. A major risk is failing to find any target or selecting a poor quality business which could lead to liquidation without returning value to shareholders. In conclusion, Solarius Capital Acquisition Corp is a company in formation with its future hinging on its next major move to acquire another business. They've laid the groundwork by raising capital, but the real substance of their business will only emerge after that crucial acquisition. We'll be keeping a close eye on their progress. Alright, that's our breakdown of Solarius Capital Acquisition Corp's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description to continue the conversation. Thanks for watching. See you next time.